Welcome to the Global Youth Economics Forum. Hello, everyone, and welcome to today's session. I would like to introduce Allison, from whom we will be conducting a fireside chat with. A few highlights about Allison is that she is an economist and has worked at various companies such as the International Monetary Fund, the Economist, Quartz, City Journal, and the Manhattan Institute. She received her Ph.D. from Columbia, specializing in macroeconomics and public finance. She is also the author of her most recent award-winning book, An Economist Walks into a Brothel, which focuses on the 5 principalities of risk. Her expertise is in pension finance and saving issues. She designs defined contribution strategies that help people invest in their retirement assets. Now, let's jump right into it.
I guess mathematically, it would take the form of a probability distribution. That is all the things you can imagine happening and how probable they are. Obviously, that's distinct from uncertainty, which in economics we think of as nighttime uncertainty, which are things that would be off distribution risks, which are things we never imagined happening.
Yes, thank you so much. Lena, you could go ahead.
Yeah, great. Thank you so much for your response. That was really great. The next question I had for you is that there are several fields within economics, such as behavior, financial, even very quantitative focused fields such as econometrics. Which one are you most interested in, and which one do you think has more scope for future research?
I think they're all interesting. I mean, my background has always been in retirement economics. And one of the reasons I think that's a great field is it takes all of those into account. I said my original training was macro public finance, but you can't really do retirement economics properly unless you really also think about labor, unless you also think about behavior. And later, when I got turned on, and this inspired the book Financial Economics, which is the study of risk. Risk is very central to all problems in economics and traditionally got a very short shift, except for financial economics, which was focused singularly on risk. But I think one of the more exciting parts of economics right now is integrating risk into labor, risk into macro, and taking what we've learned from finance into those areas. And I think that's the most exciting research. And I think what retirement economics, anyway, it's not known as the most exciting field in economics, was at the forefront of really combining different fields together, because I think they're all interesting. They all have something to offer. And, they're all quantitative in their own ways. And, one thing I try not to do is shy away from math. So ideally, you'd get exposure to all of them and draw on all their lessons.
Yes, thank you so much. So our next question is that because we usually don't get the opportunity to talk to an economist and get to ask them more generic questions, is that like, what are your views on the current economy? What do you think is the biggest drawbacks that we face, and how do you think we are going to rebound? And this is not a country specific, like not the US, but in general, like the global economy. How do you think we're going to bounce back, and what do you think is the outlook for the next, you could say, decade or so?
Well, I think it's mixed. I think we're going to have a lot of growth for the next couple of years as we come out of the pandemic. But long term, I see a lot more concerns, particularly for the global economy. I think a lot of the strides we've made, both in developed and developing markets, has been from greater globalization. I mean, there's huge gains from trade. And we got a lot of people out of poverty for that reason. And people in developed countries got, also a lot of benefits from that. But I'm worried there could be a bit of a pullback. We're seeing that with a lot of American policies right now, a pullback from trade, which I think would be bad for Americans, but also particularly bad for people in emerging markets. We're also seeing, certainly with American policy, and generally when you have a big shock, it exposes there's a lot more risk in the economy than people thought, probably always there, but people forget. So we tend to have a more reliance on government to take on more risk for us. And that usually comes at a cost of lower growth. So I think we're going to see a lot of growth, probably growth like none of us have ever seen for the next couple of years. But longer term, I'm worried about a pullback from trade and a bigger government presence pulling back from risk in our lives.
Great, thank you so much for your responses. The next question I had for you is, in economics, we have many models and theories that are always disputed, criticized, and debated upon. So according to you, what makes an ideal economic model or theory, especially if someone is trying to come up with a new one?
It's hard to come up with an enduring economic theory. I think because one thing that makes it so hard is the world's always changing. And so I think what makes a good theory is it holds up under a lot of circumstances. Nothing's going to hold up under every circumstance. Obviously, things change. As when you study economics, there's all these preconditions before every model, and those preconditions are very important. But what is the most general is usually, I think, stronger. I think finance is a lot of those. Like, for instance, you get a higher return if you take more risk, things like that. The idea that you can quantify risk, I think those concepts are fairly enduring. I'm personally not a huge fan of a lot of the new empirical work coming out because it tends to be very specific to certain circumstances. Like a lot of these RCTs require very specific circumstances, so it's very hard to generalize them to other areas. I think moving away from theory, that kind of happens more. Theory tends to try to be more general. Empirics tend to be a little bit more specific. Empirics are a great way of testing theory, but they're definitely not a replacement. So I think when people say, oh, this theory didn't work or it's outdated, I think you want to look at, well, the circumstances change that make that theory not work anymore. And are those circumstances unique to this specific area? Has the world changed dramatically? Do we call it a structural change where the world's forever different? Or is this just some weird blip about this particular circumstances that we can still stick with the theory?
Definitely, I think that's a good way to sum it up. And our next question is that, so this is obviously something that's trending and something that's made me curious a lot because I've been wanting to get into it. But how much do you think cryptocurrency and advancements in fintech will change how our economy will behave in the coming years? Because a lot of governments, you would say old governments and banks look at cryptocurrency in a very different way to our current generation. So do you think it's going to have a huge impact? And a sub question that would no, I think you can answer that question first, and I can ask my second question later.
Well, I
Thank you.
don't know if a huge impact. I don't really understand it personally very well. I think everyone's very interested in it. A lot of very smart people are interested in it, which means I should feel like I should be more interested in it than I am. But I think as an asset class, I tend to be very skeptical that it has value. I mean, just because something goes up in price for 10 years doesn't mean it does forever. I think people who study financial history are very aware of that. So, I'm told that some of the technology, the blockchain technology, really can be life altering. I'm not quite sure how. Maybe it will make transactions easier. But as I said, I don't totally understand it myself.
Yeah, and a sub question that not about cryptocurrency, but like the way general consumers these days behave. So I'm not sure, but if you followed the GameStop saga, like
Mhm.
hedge funds versus people on the internet. So do you think that there's a rising pattern that we're seeing here, or a worrying pattern for like people on Wall Street or big hedge funds being controlled by, let's say, investors, smart investors on the internet? And like, what are your thoughts on the whole sagas in all?
Well, I'm not sure how smart those investors were. I mean, a lot of them lost money. One thing you learn in finance is it's one thing to earn money for a couple months, a year, or even 10 years. It's another thing to earn money consistently throughout your career. And that is very few people can claim to do that. I think generally, I think more people should own stock. And during the pandemic, people were stuck at home with money to burn and people were investing, day trading, people who I were friends with who never even knew anything about the stock market. And actually, I generally think that's a good trend. I would like to see more people involved in investing and taking more of an active role. Although I generally don't think day trading is the best way to do it. I'm a fan of index funds. When you learn finance, you learn that investing is always risky. You never know if an individual stocks can go up and down. But if you own a lot of stocks together, on average, you'll get a higher return and less risk. So it's like probably the only free lunch in finance. It's not as sexy as day trading and picking stocks. If people want to do that, I personally wouldn't. But I also think there's some benefit into people getting more engaged with the economy. I think you just have to be prepared to lose that money and then put some of your portfolio in index funds that you're looking towards for more long-term growth.
Great, thank you so much for your answer. The next question I had for you is, do you have any advice for anybody who would like to pursue economics in and beyond college, and what opportunities do you think are available for them to make these changes?
So I did my undergrad in the UK, far from I went to Edinburgh University. It was a great school, but not I'd say in sync with the elite research universities in America. In a lot of ways, that was a great experience for me because one thing I loved about the UK experience is they really nurture your passion for the field. You might not get as math exposure as you need for an elite PhD in America, but I think a lot of ways your passion for the field is sometimes more important because it's a long road to hoe. And I really felt very passionate that I wanted to be an economist, and I felt like it was a calling for me. So I would encourage anyone who feels that way, or even a fraction of that enthusiasm, to pursue a career in economics. It's a wonderful thing. I remember when I first started taking economics, I really felt like I was learning all the secrets of how the world worked. And to me, that was just so inspiring. And every economics class I took, I wanted to learn more and more. And I've never lost that. Like, I still feel that way. I've run out of classes to take, but I get to talk to smart people. I still get that experience. So I said, if anyone feels a fraction of that, I would keep going. Certainly had a lot of setbacks and people who told me I wasn't qualified. And at certain times I actually wasn't. So that was actually a fair assessment, but it didn't matter to me. I just was so hungry to learn everything I could about the economy. And anyone who does that, I think the world and the profession offers so many opportunities, and I'd encourage anyone to do it.
Yeah, thank you so much. That's a good insight. And I would like to ask another question that's more of a personal one, I guess, because you're so passionate about finance and risk in general. And I think you went on the part on, taking a PhD in economics. I think I would presume that most people in finance, their career paths involve like an MBA, going to a business school, and then working for, let's say, investment banks or hedge funds. So could you give us a reason of why you didn't want to follow that path? Or because you're so interested in finance, someone would assume that, you would go into that field as well. But why didn't you make that decision to do so? Like, following what most people generally do.
I actually didn't develop an interest in finance till after grad school. I was interested in economics. And so I found myself in an American PhD program, and I was always interested in retirement. So I was working on that. And then it's a very long and not very interesting story, but I ended up not in academia. And I ended up meeting Robert Merton, who is this famous financial economist. And he became my mentor for several years and taught me finance. And learning finance from someone like that made me realize intellectually what an exciting thing. I always dismissed financial economics as, well, when I was an undergrad and knew people going into banking, I thought it was cool because I like markets. Anyone who's around markets, I admire, but it didn't really intellectually interest me because I didn't feel like I was gaining those secrets of the universe. I felt like I was just crunching numbers and answering questions that didn't interest me, or I had no control over the questions I would be answering. And even all through grad school, my exposure to financial economics was mainly empirical. Can we find little deviations in efficient markets theory? And that seemed boring. But when I started working with Merton and then later Jean Fama, I realized there were huge questions finance was answering, very exciting, interesting questions. Like the whole concept of putting a value and price on risk all of a sudden, which is the central question in finance, became really exciting to me. So I think I didn't get the exposure early enough to pursue it. And I think if you do work in financial services and do an MBA, you could be doing, I know people who've done some really interesting jobs and some interesting work. It depends on the path you take. But certainly in the start, you don't get that sort of exposure. Or I know people have had very great careers in finance who never really probe deep questions. I know people who've had careers who did. I think it just depends on you.
Thanks so much for all your responses. So now I'm just gonna open it up to audience Q&A, and I did see some questions, some prior chat too. The first question is from Carmen, and she asked, "What is deflation?"
What is deflation? It's when the price level falls. So when prices fall.
So yeah, I think adding on to that, I would want to ask you, because you're an economist, I would like to get your perspective on, do you think we are more prone, let's say out of a pandemic, do you think we're more prone to a deflation? Because let's say there are many articles that discuss the fact that, we have tech increasing, basically increase in aggregate supply, and then you have price bubbles and many factors that might attribute or contribute to deflation. So do you think we're on the verge of deflation, or are we pretty safe into not going into that region yet?
I'm not that worried about deflation. I'm mildly, although not excessively, worried about inflation. I think more inflation than I think high, persistent, or unpredictable inflation is actually more dangerous than deflation, unless it's very large deflation. I think a little bit deflation, the sort of minor amounts that we've been flirting with, if you're not in Japan, has been pretty actually a minor, even borderline beneficial. So I don't see a huge drop in prices, especially we have so much pent up demand and so much government stimulus. And the Fed is definitely not going to be putting the brakes on price increases anytime soon. So I'd say I'm more concerned that we're going to deal with more inflation than we're used to. There's a big generational divide. Anyone under 45 has never really lived with inflation. They have no concept of what uncertain prices even look like. So I think I'm more concerned about that, although not excessively so, at least not in the near future.
Okay, yeah, definitely. So just one more question before we move on to another question from the audience. So we know that in Japan, the reason why deflation occurred, or there's a deflationary spiral, is because it's mostly down to demographics, the way people behave. because it's known that Japanese population, it's dominated by old people, right? And they're very prone and have high tendency to save. So let's say you're part of the Japanese government, you're part of the central bank. So how do you get people to spend more? Because I've heard that a lot of like the Japanese government since the 2000s have tried a lot, cutting tax rates, cutting interest rates. They've tried a lot to get their country to spend, but their country just don't seem to spend just because of the way their culture is, their habits are. So how do you do that to change a nation to actually get yourself out of deflation? Because it's not down to other external factors, it's just down to the way people behave. So how do you fix such little things that are kind in some sense very devastating to an economy?
Well, I mean, one good way is insurance, right? So you have older people who are afraid to spend their savings because they're worried they're going to run out of money. And what we could do is we could pull their risk, like they could buy an annuity, right? So everyone puts their money together, everyone gets a certain payout that they get till they die. People who die young subsidize people who die old. And that way you have that certainty. So you don't have to hold on to your money in case you run out of it. I mean, another reason why retirees don't spend in America is concern about healthcare, because not all healthcare costs are covered by Medicare. So I think insurance is a good way to get people to spend more rather than just, lower interest rates, on the margin. It has some impact on behavior, but what you really need to do is reduce the risk it gives people an incentive to hold on to their money.
Awesome, thank you so much. And there was a private chat question from Emily, and she asked, can you expand on how government presence in the market interacts with the risk aspect of investments and such? I personally believe that more government would be beneficial, but I'm interested in your take.
Well, I mean, I think what we're seeing certainly in America, I haven't been following it abroad quite as much, is the government becoming a more proactive investor in the market. Specifically in America, there's plans to tax a lot more the corporate sector, tax return on risky investment, private sector investment. And we allocate that money to government projects where the government chooses which investments to do. And sometimes that works. Sometimes you have investments that we should take, but we don't undertake, like things around climate, because the payoffs are very far into the future and very uncertain. But there's positive externalities like a cleaner planet and all those happy things. So you want the government to get involved. So people might, as I said, you get around that sort of market failure of people not really sort of being afraid to take these long-term risks, not realizing the externalities to a cleaner planet. That said, there's also a lot of downsides to having the government more involved in investment. I mean, mainly in the private sector, when you choose what investments to take, you are paying the downside risk. You lose money, you lose money. And the government, the people who decide on different investment projects really don't have any skin in the game at all. So, and tend to be a lot more subject to political capture. So, I mean, investment in innovation is always very risky. It's really hard to pick right projects. If it was, everyone would make money. And when the government makes those choices, they tend not to be a lot better at it than individuals. So, I mean, that's why the history of industrial policy has been sort of not so great, because it's really hard to choose the right projects, particularly when the incentives aren't aligned. So, I mean, Sid, I think there certainly might be scope, certainly around sort of greener technologies, but we don't really want to go overboard with it and really restructure a whole economy around it.
Awesome, thank you so much for your response. And the next question that I see is, could you talk more about the benefits of index funds versus day trading?
Yes. So there's this ironclad rule in finance, which is the more risk you take, the more return you get, right? But the one exception to that is when you can diversify, right? So if you hold this, we have this thing in finance called an efficient portfolio, which is this, if you just pick this magical combination of stocks, you'll get a higher return and lower risk. So we call free lunch. And it turned, so, for years, the mutual fund industry, like everyone, that was their marketing thing. I found this magic portfolio, all these fancy formulas. But then it turned out after a couple of decades of research that if you just buy an index fund, that's pretty efficient. So there's no reason to pay the high fees for someone to handpick these stocks. And right now, I mean, index fund fees are so low, they're like one or two, like 5 basis points. It's crazy. So you get high, on average, you'll have a higher return and you'll have less risk. Now, if you hold an individual stock, it's what we call inefficient, because that we have we call it idiosyncratic risk, which is the risk that this individual stock is going to go up and down, and you're not holding another stock to counter it out. I mean, you can pick those stocks yourselves, but it's very time consuming. And as I said, you won't do as well as just holding a lot of stocks. So it'll save yourself a lot of time and money just to do that. So some people find trading, holding individual stocks in Robinhood really fun. And if you find it enjoyable and you're prepared to lose money, then, people should do it. Sometimes people make money doing it. Sometimes they don't. Sometimes you'll go up, sometimes you'll go down. But I think that engagement is healthy. As your primary investment portfolio, I would go with index funds.
Yes. Okay. The next question we have on the chat box is, what is your take on the capital gains tax? I think it just came out yesterday, 2 days ago. And so is taxing the rich the solution?
Well, I mean, we definitely need to raise more revenue. We're spending like crazy. And I think we definitely want more progressive taxes. How much the rich should pay versus how much everyone else should pay is a question of values. And as an economist, I don't honestly have a firm view on it. My take as an economist is like, how can we raise as much revenue as possible in a progressive way while causing as few distortions as possible? And generally, economists aren't big fans of taxing income on capital because it's very hard to do. I mean, you don't like when you get tax your income, you get paid every year. You're not going to not get paid 1 year. But when you tax capital income, you can just put off paying that tax, right? You just don't sell the stock for a while because you're going to have this huge capital gain on it. So you'll just put it off until markets are down or when you need the money. So what you end up doing is people aren't buying and selling stocks based on market fundamentals. They're just basing it based on like tax code, which just sort of distorts everything and make things quite messy. Also, investment is good. It's something we should encourage. It feeds long-term growth. To some degree as well, capital gains taxes are double taxed. You've already paid the tax on corporate profits. It is double taxation, which is generally why economists aren't huge fans of taxing capital income. Some say it should be zero. I wouldn't go that far, but I definitely think 50%, which is what we're talking in a lot of states here, is absurdly high. That said, it's for very rich people, which is all the more likely it's not really going to bite. Rich people are very good at hiring accountants. There's a million loopholes in the American tax system around capital gains to get around it, certain privileged asset classes, all these sorts of things. So really all we're doing is we're buying a more inefficient tax system that's kind of like makes markets a lot less efficient. But we're not really going to get that much revenue. So I think, well, I'm sympathetic that we need to raise more revenue, and I'd like to see that happen in a progressive way. I think we have a lot better options.
Awesome. Thank you so much for your response. The next question is, what is your personal risk tolerance? And I guess just like the follow-up to that is, the term loss often tends to have a negative connotation. When can capital losses be beneficial?
That's a good question. Both of them. I'm researching a new book, and I think a lot about personal risk tolerance around that, even my own. I think we all are for certain risk loving in some areas of our life and risk averse in others. And I think even that changes throughout our lifetime. I'm getting concerned that we are taking less risk, particularly younger people are definitely prevented from taking the risk they should. When you're young and early in your career, it's the best time to take risks and try new things. But between cultural norms and certainly a lot of institutional constraints, it's getting harder and harder to take risk, which worries me a lot. But as I said, personally, I think of myself as I can be so risk averse in so many ways. Like I won't even ski. Like that just seems crazy to me that people put on slippery sticks and go down an icy mountain. On the other hand, like I've had a pretty risky career in other ways. So I think we all are have that in us. Like some people, as I said, I even saw this a lot with the pandemic. People who would ride their bike through city streets in the rain throughout the pandemic, and we're fine with that, but God forbid they'd walk outside without a mask on. I feel what do you think is really riskier here? And but they have their own way of measuring risk. They have their own risk tolerance. As a risk person, it made no sense to me, but made them feel good. So I'm not going to argue. In terms of loss, I mean, I'm not sure when capital losses can be beneficial. Personally, I'd rather not experience them. I mean, I suppose there are some tax implications there that are good, but that's not really something I fully understand.
Yes, thank you so much. So following up on that question, that's a good way to put it. We talk about risk so much in finance, but we don't consider risk in terms of not wearing a mask, going for a ski. But my question is that we've seen this behavior in terms of when people buy stocks or when people invest in companies, they're impatient, and the fact that they're addicted to, let's say, the market. Is it going up? Is it going down? And the slightest movement where it shows that this is really risky, you're not going to get a return on the investment, it creates impulsive behavior. You either sell it or you don't own that stock anymore. So what is your tip to someone, let's say I turn 18, I'm currently 16 right now, I turn 18 or 19 and I start investing in stock when I'm in college. So what advice would you give me? Because let's say I invest in a stock, and I would say that I would, for 6 months, I'm ready to be patient. But let's say it goes above that point as well, like my risk tolerance level. What advice would you give to someone, who you want to stick with that stock? What's your general consensus on that?
I would just not look at the price. Just is it. If you're investing for the long term, just, put your money there and just don't look at it. If you feel like you're going to need that money in the short term, it probably shouldn't be in risky assets. As I said, unless you're day trading as a hobby. But as I said, it's very hard. Day trading and beating the market is very, very hard. And you're up against like hedge funds who have like lightning fast algorithms. Some people make money at it. What I do is I invest in index funds and I literally never look at it because, like when it's up, it doesn't feel real. When it's down, I get upset. So I think the key to patience is just to zone out from it.
Definitely, thank you. We can transition from a bit from risk and finance to a bit concepts or like questions in macroeconomics. So, being an economics student myself, we study a lot because in our curriculums now we have an integration between sustainability. Our boards or like our education systems want us to learn more about sustainability, things like green GDP. But what we've learned is that one of the greatest drawbacks to things like green GDP or these indicators is that you truly can't measure the economic value or the economic damage of, let's say, harmful ways of producing or manufacturing. What is your take on the fact that green GDP is still really hard to get? Like, how can you actually transition to, let's say, an economy that's actually based on renewable goods and sustainable energy in general? Because it's really hard to do that. We just make estimations and make papers and reports, but some of us really truly don't know the economic damage that non-sustainable methods do.
Yeah, it's really hard. I don't think there's easy answers because said when I was talking about risk that's measurable, this is really unmeasurable. The impact of climate is so much unknowns around it. It could be this huge existential threat or it might not be, and it's really impossible to know. We know it's likely harmful. It's also true, though, that we shouldn't give up on growth because historically, growth is what allows you to use your existing resources more efficiently. So I think when people sort of get down on economic growth as a means, they assume that's bad for the environment. It's actually quite good for the environment. I think the problem is a lot of countries are earlier in their growth cycle, so they're not being very green. But if they continue to grow, hopefully they will be. And I think that can help a lot. But it is an area where I think we're making progress. Traditionally, the models, as I said, have been some very sort of weak estimation because we just don't know. These things are very, very hard to measure. And that makes the challenge particularly difficult.
Thank you so much for your response. The next question that we had for you is, some economists say there won't be a fully functioning economy again until people are sure they can return to work without catching the virus. Is this true?
Yeah, probably. I think I worry now. I'm noticing some people might not ever get there or might take years to get there even after the virus becomes a minor threat. I think, yeah, we're not really going to fully go back. You think, I live in New York. If you go to Midtown Manhattan, there's so many like delis or sandwich shops that are just dead. They're not going to get their business back until this is a thriving, huge amount of people running in and out every day. And that's going to take some time. A lot of people are very fearful and are having problems letting go of that fear. And I understand why. So it's going to take some time.
Yes, thank you. So there's a question that I would personally like to ask is that there's a lot of debate about, let's say, college tuitions and college fees, especially in America, where people say that it's too expensive, let's say for international students, for some national students as well. So do you think that reducing college tuition fees is a solution? Because I've heard a lot of things such as, lawmakers and policymakers are favorable of the idea of reducing college tuitions because it might increase or like better the debt or like, what many students go through. And because it allows more people to have access to education, like good education, so that makes them more accessible to, let's say, the labor market as well. So do you think it's a solution, or do you think it's going to stay this way forever?
It's a hard problem because, like, say, take the UK, which for a lot of years did have free tuition. But at that point, the government could only send so many people to college because it's expensive. So actually, when the UK had almost no tuition, it was actually very elite. And it was actually when they opened it up to more people, it all of a sudden became unsustainable. So then they started charging fees. I think a better solution, I think the American system isn't as bad as it looks, although it definitely has its issues. Having students from wealthier households pay fees and having them effectively subsidize low income households, which they do to a large extent in America. Usually those big prices, a lot of students don't pay them because there is some level of redistribution. And I think that's better because if we go back, I said when the UK was charging zero fees, it was like 1 or 2% of the population. People, most of them went to fancy boarding schools, were the only ones going to university. So I think you do need people to put some money in. But the question is how can you do that in an equitable way and subsidize students who come from families where they can't afford it?
Thank Thank you so much for your answer. The next question I had for you is, what book are you currently reading?
I just got Lauren Siegel's new book. The name has escaped me. I'm embarrassed to say, but I've been about finance and he just sent it to me. So I'm enjoying that. I recommend it.
Thank you. I think we'll note that down. My next question is that the CPI is a system, you could say it's pretty good. But again, it's been under huge criticism of the fact that, sometimes it overestimates things, underestimates things. And during the COVID pandemic, obviously it has seen its flaws because of like a supply and demand shock. So what is your take on like the CPI in general? Is it a good way to, indicate inflation? Because inflation is a pretty important indicator for like an economy's health. So is the CPI a good measure, or do you think it needs some change, especially in terms of the baskets of goods it encompasses?
I don't really know. I mean, I think it depends on what you're trying to measure. Like, as I said, for urban consumers, it's useful. I think if you're looking at retirees who spend a lot more money on healthcare, it's less useful. I don't think it's so useful for looking at income over time because the basket of goods changes and the quality of goods change. But I think it certainly is useful. I think as a good gut check of what's happening in the economy, it is. I think it's just you want to apply it to the right situations. It doesn't always get applied. Sometimes it gets applied too broadly, but sometimes it's applied appropriately.
Great, thanks so much. Carmen has a question. What is your favorite book to learn about economics?
That's a good question. Actually, I like Freakonomics. It's kind of getting old now and is sort of tired to say, but I think it actually, for me, or wasn't for me, I was in grad school then. It was really, I think, life-changing for me as an economist because for the first time, people realize economists just aren't picking stocks. I think it's a great intro to how economists think, how they think about incentives, and it's a good read. So I actually still think it's a great book.
Yeah, I'm such a huge fan of Freakonomics too. But
Yeah,
next
people are always
question.
surprised when I say that because I think it's just, easy. But I think the fact it's easy is what makes it great. It was actually explaining some very sophisticated, important ideas and made it so accessible. It really is an inspiration.
Yeah, definitely. Next question for Mara is, do you recommend any specific index funds or stocks that people should look into investing in?
Yeah, I guess it depends, like if you have access to Vanguard, or I'm not sure which ones you have access to, but what I would look for, and this is true whether you have here it's mainly Fidelity and Vanguard, I also have a lot of DFA funds, is I look at fees. I want them super low. And just personally, I guess being a good economist, I look for funds that have as many stocks as possible around the world. I like a global fund because I'm still betting on emerging markets and other countries to have higher growth because they've just got more to grow. So they're riskier, but I like index funds that are global and cheap.
Awesome, thanks so much. Another question is, how is economic data collected and verified for various studies?
It depends on the data. I use a lot of government data, which is often surveys. Lately, I've been reading a lot of papers. I don't have access to this data on tax data directly. That's also great stuff. A lot of economists are using that now. As I said, we have the randomized controls where economists find these odd little experiments. Sometimes, again, they collect it through surveys. Other times, they collect it through taxes. I mean, generally, when you have an economic question, it's always like, where am I going to get the data? And that's a big challenge. Finding good data is always hard. In the age of big data, we've got a lot more, but it doesn't always mean it's better.
So I put a question in the chat box that says, how long will China sustain its, leading economic power status once it surpasses the US? I think it's predicted 2025, if I'm not wrong. But like, let's say once that happens, how long do you think China will be able to sustain it, and we'll see another contender for economic superpower, let's say India or any other country?
Generally, if India can get past some of its issues, which are considerable, I've always been more bullish on India. First of all, China has some long-term issues. First, its aging population is going to be a real problem. Also, I don't know if China's really proven a good model of innovation. What makes it's one thing to adopt existing innovation and put a lot of people and buy a lot of capital, but actually coming up with new innovation is hard. And maybe China can do it, but I don't think they've really proven that. I've always been more bullish on India being a center of innovation just because, partially because of the challenges they have, people have to be so creative. I think China is going to hit demographic issues and potentially the rich country problem, which is it's one thing to grow quickly when you have a lot of people who come on the market very fast and you have a lot of market proven technology you can throw at your people. But sustaining that and continuing to grow at that rate is very challenging, especially if you don't have the creativity and innovation, which I wonder if it's possible in that sort of market structure, because you need people to be innovative, you need to be able to reap the returns of those innovation, and you have to allow people to fail.
Okay, yeah. So there's one more question from the private chat. How does artificial intelligence affect the economy? So as a disruptor, how much do you think the whole economy will have to like start from scratch and maybe come up with something new?
Sorry, how's artificial intelligence?
Okay, I'll put it on the chat box. Wait.
Okay.
Affect the economy or disrupt it, yeah.
I don't know yet. It's a wait and see. I think it definitely has potential. I think all new innovation can be really transformative, but I think what we learned from the Industrial Revolution is what innovations really change the world is always really unpredictable. The things you think aren't, like the steam engine, which really changed all of our lives. Didn't really take off for like 100 years. People are very excited about AI. I don't think it will really take over for humans in a meaningful way. My theory is after the pandemic, we're going to do a lot more remote things. So I think in-person encounters are going to become like the new most valuable commodity. Human interactions and human thought will become even more valuable. I think it's definitely will make some things cheaper, more accessible, but how much will transform the economy, I'm still not sure.
Great, thanks so much. And I also saw some questions in the Q&A box in the Slido, so I'm just going to use it. What are the uses and limitations of economic data?
Well, I mean, you can test all sorts of things. It's amazing. You can have a theory and you can see, how well it works and how do people respond to incentives. You can learn so much. It's incredibly valuable. But I think a good economist also are aware of the limitations. As I said earlier, is there something about this particular circumstance? If you give people money in an African village and they behave a particular way, can you generalize that that's going to be true in, Cleveland? I mean, maybe not. So you want to be aware of data's limitations and what translates. I think another issue with data is that the world's always changing and data is by definition from the past. Is the inflation experience from the 1960s going to tell us anything about right now? Probably not. I mean, the economy is very different. How prices are formed, commerce is different. So I think, I always feel like data is terrible. It's a terrible way to answer questions, but it's also the best thing we've got. So you just kind of have to use it and realize it's a guide, but it doesn't really give you definitive answers. And that's why I'm skeptical push in economics now towards these sort of very definitive statements about causality, because, data never really tells you that much. It just kind of is usually suggestive.
Great, thank you so much. And another audience Q&A question was, what in your opinion is the most important quality in an economist?
In an economist? Curiosity and openness. I think you got to be, one thing I love about being an economist is I feel like I'm always learning more. I look back 10 years ago and I was like, I knew nothing. Everything I thought about the economy was wrong. I'm excited by the idea in 10 years, I'll think that again, or I hope I do. Because the economy changes or you learn the assumptions you had before didn't work. So I think a curiosity and openness is the most important quality you can have.
Yes, thank you. So I think we'll wrap it up with one final question, a pessimistic question, in fact. So what do you think might be the cause for the next economic recession? Because we've learned from our financial crisis, we've learned from our pandemics and epidemics in general. So are we seeing a perfect economy in terms of the fact that nothing else can occur now because we've learned from mistakes? Or do you think there's still an outlier, a region which could affect the global economy the way it currently is?
There always are. I mean, we're going to have another recession. It's going to be bad. I don't know when, I don't know what's going to cause it, but I can guarantee it's going to happen someday. We've never, just when we think we've outsmarted the markets, it just doesn't happen. I mean, things I worry about, I don't know if it'll be bad. Maybe it will, maybe it won't. As I feel like just the level of distortions we have in financial markets worry me. I think the pricing of risk becomes distorted. I think people make bad risk decisions and then you have excessive risk that isn't well grounded in fundamentals that tends to some nasty things. I worry about inflation. What we're going to do then, is the Fed actually going to bring us into a recession to fight it? If that's necessary, I'm not sure. But you never know. I guarantee you whatever's going to take us into the next recession, none of us have thought of.
Awesome. Thank you so much, Allison. It was really nice talking to you and just like sharing your insights and answering all our questions. I also just put the attendance form in the chat. And also, if you guys all could like put thank you in the chat to Allison for coming, that'd be great. Show some appreciation. And once again, thank you so much for coming, Allison. It was really nice. It was a pleasure interviewing you.
Thank you. Thanks for having me.